right, welcome everybody. So just you see the slides up here. Already, hopefully got your sound already set up. Also note that if you do have questions, please use the Q&A button down here to put in your questions in there. So with this, I'm going to turn this over to Eric and Lee, and they're going to start for our presentation for us here.
Thank you, Sean, and good day, everybody. It's great to see that a lot of people are signed up for this. Hang on, let me just, there we go. Today is the first of, here, I need to go back a little bit. Here we go. All right, I know, I'm still learning, right? Today is the first of 3 workshops on implementing GASB-87 leases. We are taking advantage of today's technology to meet with more than, we're about to hit 600 plus participants at one time. That's really, really great. Now, while there are limitations regarding webinars versus in live training, we've made today's and the other lease workshops coming up in the next 45 days or so as interactive as possible, given the fact that we are still largely remote, even though things are easing, and it's great to see a lot of people out and about. My name's Eric Berman. Joining me today is Lee Miller from our Boise office. Both of us are on Eide Bailey's GASB-87 subject matter expert team. Today's focus will be on the lessee side of leases, knowing that most governments are in lessee positions. Come back and see us in July for the lessor side, and we'll talk about that later on in the webinar. Today's session will be a quick overview of GASB-87 leases. Again, we're focusing solely on the lessee side of leasing. We're going to try to make this as quick as possible, as I'm sure you've seen many presentations on the basics of GASB-87, but just in case, we'll spend about 15 minutes reviewing. And as I like to say, 10 times for the normal mind, 100 times under stress. We're all under stress after all the June 30 governments out there. They got to get going in terms of implementing GASB-87. Then we're going to begin to get our hands dirty on 2 leases. We'll talk about some policies and procedures to focus on that we've seen so far in our implementations that we are working on, and then discuss what areas to focus on to implement. One thing you'll realize through this session and through the other 2 sessions is for most governments, unless you have perhaps less than 25 leases, and that's a ballpark number because every government's different, that you're really sure about, implementing GASB-87 will not be easy. This GASB standard is not a standard where you implement and then it's on cruise control until it's changed by the GASB way into the future, like most GASB standards. With each new contract signed by your government, you're going to need to consider whether or not GASB-87 applies, along with the other 2 standards we're going to discuss in our final workshop coming up late in July that use the same framework from GASB-87. The implementation provisions and ideas that you're going to hear about in this workshop and in the next 2 workshops, you'll need to revisit each period from now on. And notice I said period. I'm not talking about within 2 weeks of when the auditors show up. Each lease is really going to have to be revisited. And in fact, not even just leases, every single contract you're going to have to do some form of work on to make sure that it either applies under GASB-87 or doesn't apply under GASB-87. So with that, this is going to be fun.
All right, thanks, Eric. So let's go through some of the basics of GASB-87. Again, we're going to be focusing strictly on lessees for this workshop. And if you want to, you can join us in July for the lessor side of things. The world of leasing is changing for every organization globally. It's just not only governments, but it's for-profits, not-for-profits, Governments will be implementing at the same time. We've got tribal nations, airports, ports, marinas, utilities, casinos. You get the general idea, but all will be implementing this year and perhaps next. Now, there's certain aspects of the new standards that are easier than the other aspects, but by and large, the lease standards that have been impacting, your governments have been around since the 70s and some aspects the 40s. Now, these are long entrenched, provisions that truly needed to be updated for the current practice of the things that are going on in today's world. Due to the lack of evolution, leases have been, financially engineered to fit into various exceptions. It always seems like we're always working on the exceptions to make it work. So, well, this raises, a lot of huge problems. There are many operating leases that are really non-cancelable. You may want to think about what you're facing. And so, you look at your operating lease disclosures. If you have operating leases listed in note disclosure by until 2065, well, by my calendar, that's a 44 year lease. I don't know how many I've seen over the years, a number of leases that are for 99 years. It seems to be some sort of a magical number. Maybe it's something that people know they're not going to be around, so let's push this thing down. So, another challenge is the financial engineering built into many contracts. In many cases, governments are, they're limited from issuing any form of debt, and a lease is a debt after all. And as a lessee, you sign a contract, you have to fulfill the terms of the contract, and you live under those constraints. Now, one of those terms is that debt needs to be paid somehow, some way. And this is the part of what we're facing as we all implement together GASB 87. Now, due to the change provided by GASB 95 last year, we did have an extra year to implement. And I think pretty much everybody, including ourselves, like, oh, good, we can push this off here. But, that year is gone if you're June 30th government, and with the June 30th, we've got 7 days to make your beginning balance adjustment. If you have a fully comparative financial statements like some of our clients and prospective clients, your government is going to need to implement this past July 1st if you're June 30th government. So timely implementation becomes an audit issue this year. The time for gathering information, gaining the knowledge, adjusting policies and procedures where is needed is now. It's those things that we need to be doing right now. As Eric mentioned, we cannot emphasize enough that GASB 87 is the gift that keeps on giving. You can't implement 87, move on. So each potential contract may have a leasing element in it. So the internal controls needed to recognize, the potential lease are key to success this year, but it's for each year into the future. All right, so one final time to go through this. So what is a lease? A lease is a contract that conveys control of the right to use a non-financial asset, also known as the underlying asset, for a period of time as specified in the contract in exchange or an exchange-like transaction. Now, each of those phrases are important, especially the exchange and exchange-like phrases. For example, if a government leased land for $1 per year when the value of the land is $100,000 per year, that is not an exchange or exchange-like transaction. If the market rent is higher, which means this is not a lease, and so therefore you do not have to take that into consideration. Similar agreements in your government that may not be in scope for implementation under GASB 87. So do not assume that all leases, all signed contracts will be a lease. So you'll need to, as we'll talk about further, you'll need to make sure you understand all of the ins and outs for your different contracts. Now, there are exceptions from the lease provisions where you don't have to do any analysis. Contracts involving mining rights or oil rights, patents, software for now, that will change the year after GASB 87 implementation that are with similar provisions, and that's GASB 96, and we'll talk about that in late July. Now, the other exceptions are live plants and animals such as livestock and zoo animals. Your government may have power purchase agreements, especially with solar panels on buildings, and those are excluded. Now, there are many questions on that we have received on whether a contract is in scope for GASB 87. So let's talk about a few. Many governments sign easements with other entities. Are easements in scope? Well, an easement does provide a right to use a tangible asset, land, of course. An easement may be in scope if it has a defined period in the easement contract. However, most easements, we've run into so far are permanent easements. So that means that there's no time factor involved. And since there's no time factor, GASB 87 does not apply. Now, let's say your government signs a contract with a solar power company. The company can build a solar farm on acreage that is owned by your government and is basically sitting unused. But the solar equipment is owned by the solar company, and the contract requires your government to buy all the power generated from the farm and make payments based on the power generated. Now, the solar company then dismantles the farm at the end of the agreement, and this contract would not be in scope of GASB 87 as it is more aligned with a more of a power purchase agreement. Your government does not have control. Another type of contract that we've run into as part of the implementations have been cell towers. If the agreement with the cell company conveys control by the government, then GASB 87 does apply. Now, this could include placing the tower on government land or a connection point on a government building. However, if the government does not control the tower or the connection point, then 87 does not apply. Hopefully, you're starting to see some of the scope and the breadth of the GASB 87 just in these types of contracts that you may have. It's going to take some time for you to make sure you understand everything that's going on. Now, the biggest change due to this definition is, again, no classification of leases between operating and capital leases. There's going to be no more pretzel logic needed just to fit around the accounting definitions from the past. Since, the lease is really financing property or the right to use for a specific time frame, and the client has use over that property during that time frame, the government lessee has control. Again, the financing language is common, and we need to be careful to look for that or similar language. And in many cases, contracts that are currently reported as leases are really finance purchases. The only time that the government would record just an outflow of resources like the old operating leases would be for a contract that has the maximum possible term under the contract of 12 months or less, including any options to renew or extend regardless of the probability of being exercised. So if there's anything, when you add up all the months there's the possibility of more than 12 months, it is not considered a short term. The total amount can be only 12 months or less. All right, so let's calculate a lease term. Dog-ear this, bookmark it, print it, circle, whatever you want to do with this. Just don't circle it on your computer screen. But you'll be seeing it over and over and over again as you implement 87. So in each contract, there needs to be identified. The first one, the non-cancelable period. This is the period where neither party can cancel the contract. And we need to ask ourselves about 4 potential options. 1, does your government as a lessee have an option to extend the lease? If yes, then you're going to add that period to the non-cancelable period if it's reasonably certain that your government will extend. The second one is, does your government, as a lessee have an option to terminate the lease, but it is reasonably certain that your government will not exercise this option? If yes, then I'll add those periods as well. Now, the third one is, does the lessor then have an option to extend the lease, and it is reasonably certain that they will require an extension? If yes, then add those periods. And then finally, the fourth one is, does your lessor have an option to terminate the lease, but is reasonably certain it would choose not to? If yes, then add those periods. Now, you sum up all the periods, and that is your lease term. Now, the reasonably certain clause is important. That is a part of the policies and procedures that need to be developed by your government. Who determines the reasonable certainty? When is a part of the and when is the part of the policy? Also, GASB does not have a strict definition of reasonably certain. However, in basis for conclusion in the GASB 87, there's a sentence indicating that reasonably certain is more than probable. So to me, that sounds like, how far is adjacent to, you get the idea. There's going to be room for some, it's going to be different for everybody because everybody's going to look at that differently. So some of us, say the word probable means 75% certain. So we are talking more than 75% certain. And again, you need to have the policy written so you have this in place so you can apply it consistently. Now, if there are periods for which both parties have the option to terminate without the permission of either of the other party, or if both parties must extend, those are cancelable periods and are not included. So governments will need to reassess the lease contract if if you were with your original prediction on an extension or termination, and the extension or termination does not occur, or vice versa. After all, the time factor, the T, will adjust as would the I factor, which is the entrance. Okay, so now that's the basic concepts. Eric, why don't we get our hands a little dirty and get into the details?
Thank you very much, Lee. And again, those are just the basics, and we can go really, far down the rabbit hole of going within those basics. But let's just stay above the rabbit hole because hey, we really want to make this as much of a workshop as possible, and really get our hands dirty. Okay, let's use the formula that Lee discussed a couple of seconds ago on a really real lease. And if one of our clients is on and they recognize this lease, we've redacted a bunch of things to protect the innocent here. We thank them for it. And again, so we're going to use that formula on the previous couple of slides ago to calculate the lease term. So this is a lease agreement that I bet you probably have. This one is from Canon for a group of multifunction printer copiers. We've seen this so far in a bunch of implementations that we're doing around the country. Canon is a big lessor, as is Ricoh and a couple of other copier companies. But certainly, this is a very common lease agreement. Here we have 60 monthly payments for $3,225 per month. We have 10 machines plus a scanner and conversion modules. And now the conversion modules are required as the multifunction printer copiers wouldn't work. So they are indeed required. Let's go down, hang on. All right, so here's some other aspects in the copier lease. And again, there is an agreement to pay Canon Financial Services. The term of the lease begins on delivery, and that is an important aspect as to when the lease term begins, because you need to have control of that property, plant, or equipment. And until you have control of that property, plant, or equipment, the lease term does not begin. Now back, and we'll get into that a little bit later. Now back to our Canon equipment, that is only a matter of a few days. But in office space, think about that. Let's say, I said, oh, we'll get into it later. Let's get into it now. Let's say that you lease office space, but that office space needs to be built out. You sign a lease, okay, today is the 23rd, but it's going to take, 4 months to build out the office space, and you might not have a certificate of occupancy until Labor Day. And guess what? That's going to straddle the fiscal year if you're a June 30 government. Now, since it's going to straddle the fiscal year and you're going to implement GASB 87, do you have a lease that requires calculation of a liability? The answer is no, because you do not have control to use the underlying asset. GASB 87 explains that the lease term commences when you have a non-cancelable right to use that asset. It further explains that the control of that asset is the right to obtain the service capacity from its use, and the right to determine the nature and manner of its use. So therefore, if you can't occupy that office space until after Labor Day, the lease term doesn't begin until you have that certificate of occupancy and the build out is done, and you get the keys and you can access that underlying asset. So going back to the copiers, until the copiers are delivered and accepted as working from the government really doesn't have control. Okay, another piece that is extremely common is the fiscal funding clause. So for budget purposes and perhaps legal compliance purposes, every government's different, of course, but for budget purposes, your government may say that until, say, the city council appropriates, we don't know if we're going to be able to renew. But you know something, in the vast majority of leases that we've seen so far, there's a slim chance of canceling the lease. And GASB knows that the possibility of cancellation is usually slim. This language also is a warranty in this particular lease that the government intends to pay at the end of the agreement. So the fiscal funding clause is there, but there's actually language within the fiscal funding clause that makes it economically really a challenge. I don't want to say impossible, but really a challenge to say, you know something, we're going to walk away from these copiers. And so because of that economic challenge that's there, the fiscal funding clause is pretty moot. This type of clause should affect the lease term only if it's, again, here's that phrase, reasonably certain that the clause will be exercised. And again, that's more than probable. Okay, so where is this all going to head? Going back to our equation, we have a non-cancelable period. There is a certificate that the government signs that Canon has delivered all the copiers in good working order and everything works and they accept it. There's a right to terminate by Canon only in the case of a default. The fiscal funding clause does not apply as this particular government signed an agreement saying that they're going to continue making payments and appropriate funds. And if it does not, the government has breached its contract and the contract terminates with a very material penalty. So the fiscal funding clause really doesn't make a lot of hay there. There's also a purchase option at the end of the lease term, but you know something, this government usually, really uses these printer copiers. And by the end of the lease term, the technology has improved and they turn the copiers back in. So now we're going to put numbers to text. Using our equation from a few slides back, we have 60 non-cancelable months where you are not reasonably certain we're going to extend, and we cannot terminate without a serious penalty. Now, Canon cannot unilaterally extend, but Canon can terminate, but only for a breach of contract. And this hasn't happened in the relationship between this particular government and Canon throughout many years. So really, we are at a 60-month term. Now, notice I'm saying 60 months and not 5 years. For those of you who still have HP 12C calculators on your desk, you know, those little blue or black ones, that weren't plugged in, you know that 60 months is very different than 5 years because of the time value of money. And we'll need to use the effective interest method of calculating and amortizing.
All right, let's go through some of the mechanics. You know, governments are going to be using this information to record an asset that's representing the right to use the element of the property being leased, along with the liability based on the value of the fixed payments or variable payments and adjusting for various factors in the time element. Sounds simple, right? All right, so the liability includes, first of all, fixed payments, which are your most common, or you have your variable payments that are going to depend on an index or a rate. And then also you could have variable payments that have minimums or maximums, you know, also known as fixed in substance. So you're going to have to make some assumptions. You're gonna have to make some estimates about, on those variable payments and so forth, when you're putting together this information. Now, this does not include payments dependent upon usage or performance. For example, if it's a car, you got miles driven, or a piece of equipment, or whatever, it could be hours used, or for most of us, since we've been talking about Canon copiers, the number of copies used. So that is not, those type of payments are not included in your leases. A little side note, if your lease is totally based on usage, that is not a lease. That will be under GASB 87. All right, the payments also include residual value guarantees that are fixed, termination penalties that may be, are present. They need to be reviewed, and for the probability of inclusions, we're back to that certain reasonableness. And the liability is calculated at a present value, and then is amortized using the effective interest method, just like today's capital leases. Now, the lease asset at the day of signing is going to equal the lease liability plus any prepayments made by the lessee, less any incentives received. So you could have a difference between your asset and liability on day one of the lease. Now, the lease asset can be amortized in any systemic, rational way if the period is shorter, of the lease term or the useful life. Now, group methods can be used. Highly recommend taking advantage of this. That meaning that the group of 10 Canon copiers can be amortized as one group of copiers, even if they could be substituted. It's up to the government of which method is going to be used, but we suggest that the effective interest method is best. And if there's a chance that the lease may be modified or terminated, the method will be and should be disclosed in the notes. Now, can it be straight line? Sure. Straight line makes it easy initially, but if you got, as mentioned before, any changes, modifications, or whatever, the effective interest method is matches better. However, like I was saying, if you modify lease later, in any way, like many are today due to COVID, or a gain or loss is more likely. So you may want to amortize the asset the same as the liability. So there is interest involved reducing the liability. Now, determining the interest element is a little tricky. After all, the lessor may not tell the lessee what the interest rate is. The lessee may have to guess that as well. And in most cases in practice, the interest rate is usually not stated. Now, you can use your government's incremental borrowing rate. However, that rate may be for a 20-year bond or longer, and for infrastructure or some other long-term asset. So therefore, the rate would not align to copiers, cars, or computers that are on a much shorter life. Now, GAAP allows imputing interest, where you interpolate an interest rate based on fair value and the time factor. Now, I went back to make sure we weren't making up the word interpolate, but it's actually there, and it's a real word, but basically you're solving for X. Now, any of these things can be an educated guess. By the way, on June 16th, just last week or so, FASB announced a proposal to allow risk-free rate as a discount rate. Now, FASB is not going to be authoritative for state and local governments if it's approved, but could the government use a risk-free rate of US Treasury, for example? Sure, but the policy, whatever you're going to do, should be documented and effectively used in a period chosen aligned to your lease term. So you need to take all those things into consideration. Now, once you have figured out an interest rate, use the effective interest method to amortize the liability, just like a mortgage. Payments are, of course, first allocated to interest and then to the payable. Okay, let's take a stop and see if there's any questions so far.
No, right now we don't have any questions in the chat, but certainly I hope folks are starting to realize that this is, this is not going to be the easiest thing to do. You can't just gather information, prepare disclosure, and move on. And so, certainly we're seeing a lot of activity over for RFPs and so on. Certainly over the last 2 or 3 weeks, we've been inundated with RFPs for GASB-87 implementation for June 30 governments, and I'm not surprised. And so certainly, if you do have any questions on it, we just did get a question in. Is it simplest to use the risk-free rate? What are others doing in practice? That's an excellent question. It really depends on the government that's out there. Some governments are looking at the bond buyer index and using their bond rating and then moving across as to the amount of years, and maybe they're resetting that amount every quarter or every half year or every year. I'm sitting in Washington, D.C., in the Washington, D.C. area, and there is, we're right near the U.S. Treasury. It's right up Route 1 here, and they're getting a little worried about inflation. And so certainly, you got to take that into account. I have another client who took a look at the U.S. Treasury state and local government securities rate and then added a factor to it. And so as long as you document your procedure and then stick to that procedure, it should be okay. There was another question. Does Eide Bailey have a template table schedule that could be shared to help entities in their implementation? We do have some marketing materials we were going to share with you in July on that, but certainly there's information on our website, and we're going to be posting additional information as to things to consider in implementing GASB-87. You need to, we'll talk about implementation factors coming up later in this program, but you really, just to give you a sense of what's needed, you really need a team. And we're more than happy to help you, obviously, implement as your trusted advisor. Another question came in, when you use the group method, what do you do with differing lease terms for each individual lease? That is a good question. So in the group method, you have to effectively align all the like pieces of equipment, copiers in this example, with the same contracts. Now, GASB has always had group depreciation ever since we all implemented GASB 34 together almost 20 years ago. I'm showing my age. Almost 20 years ago, we could effectively take an average of all of our equipment lives, even though we bought our equipment at different times and so on. So the thrust of GASB-87 in terms of group depreciation is not only to consider that, but also to consider what are called combinations. And we're going to talk about those next workshop. And what combinations are is that if you sign here 10 copier leases with Canon, that's our first getting our hands dirty. Instead of depreciating or amortizing 10 individual copiers, you amortize that all together, and that lessens the burden on your accounting system. Another question is, so we need to calculate imputed interest regardless of inclusion of interest in the financing agreement? No. If it is absolutely stated in your agreement, then use the stated number. If it is not stated, then you need to take into consideration what is your current borrowing for the similar types of contracts. Also take into account, your policies and procedures. And if you're going to use the risk-free rate of return, you gotta use it. Let's see. Do you have to have an interest rate environment, or can you just go with principal payments only? Well, this is using a similar method to your mortgage. And And you don't just have principal payments on your mortgage. I mean, there are some mortgages out there that all you pay are interest, but you generally pay both principal and interest. Another one, what do you think about the software options that are being promoted, sold for lease tracking activity and creating journal entries and reports to comply with GASB 87? And they're, they name a particular software vendor. We'll talk about that later this afternoon. But there are some good software out there, but one of the things that we have been asked to do is to help governments choose and choose the right software that fits them. There is no Swiss watch for every single government that's out there, because your government may have more or less leases, and it's a type of thing where can you can you buy a Rolls Royce when all you need is a Chevy? Sure, you can buy a Rolls Royce, but all you need is a Chevy. It really depends on your facts and circumstances. A couple other one, if there was a bargain purchase option of $1 or 100% 100% to exercises, is this still GASB 87? Not really, because that seems to be a finance purchase. So it's really a financing, not a lease. Now, you may have a legal issue in terms of recording debt and so on. So you're really going to have to talk to your legal counsel before you make the change and record a debt, if you do have a debt restriction. In terms of control, if you've entered into an agreement for the leasing of 5G cell towers, but we cannot do anything to the towers, we can't use anything or put anything on them, does this constitute a lack of control? Of the towers themselves, yeah, you probably don't have control of the towers, especially if the cell phone company can remove the towers. You really don't have control. What you do have control is the connection into your building. Would 99-year easements be subject to GASB 87? Again, that is facts and circumstances. If the easement is the useful life, well, it's usually land. If the easement is useful life, chances are it could be subject to 87, but if there's no time factor, not subject to GASB 87. Another question, we keep our books on a fund basis. How would the lease be reported in the general fund? How would it be reported in an enterprise fund? How's it amortized in each? Awesome question. Well, under current GAAP, and I underscore the word current GAAP because a couple of webinars ago we talked about the financial reporting model. Under current GAAP, in the general fund, it's mainly going to be a flows basis, meaning you're going to have an expenditure for the payment on the lease and payable for amounts that are due, that fit within your accounts payable period. And again, I'm paraphrasing, of course, because we could talk for a long time about the modified accrual basis of accounting. And so it's pretty much cash outflow. Now, in an enterprise fund, enterprise funds, you're going to end up probably recording the entirety of the lease payable that's there, as well as the lease asset. Okay, now, what if you, there have been a couple of questions on purchase options. It really comes down to whether or not you're going to exercise that option and that old reasonable certainty. How does that all work into your equation? And so it really comes down to your policies and procedures and perhaps even past management practices. Now, I've been doing a bunch of the talking. I mean, Lee, do you want to, do you have any differing thoughts, or are you okay on that?
No, nothing to add.
All right. Thank you, Lee. All right, so let's get back to our presentation. We're going to keep getting our hands dirty on the Canon lease here. Again, we're going to lease 10 Canon copiers for 60 months at $3,225 per month, including setup, delivery, software, and getting going supplies. And, you know, you're talking about your first ream of paper that they ran to Office Max and got a ream of paper just to make sure that it worked. You know, the first toner, paper, and so on. The delivery, install, and acceptance was on December 29th of last year. Our fiscal year end is coming up next week, and the government has the capacity to pay, and the fiscal funding clause was waived. Now, there are potential components out there, and we're going to talk about those components in a few minutes. We're not talking about your tape player or your 8-track or you know, so on, your record player, for those of us who are that old. No, these are elements within the lease, and we're going to talk about that in a few. Now, like most agreements, the discount rate was not spelled out in the agreement, and this is very, very common. So how do you go about setting the discount rate when it's not in the lease document? This becomes one of those important policies and procedures. Now, again, there are no hard and fast rules, as Lee and I have been talking about over the last 10 or so minutes from GASB on this one. And since every government is different, you can't really copy off your neighbor. Think about your debt issuances. Your interest rate is different than your neighbor, and because your situation is different. Again, here's what we suggest to do. Choose a method that you can easily replicate, such as the US Treasury State and Local Government Securities Index, but adjust that rate to fit your credit rating and adjust it for the time of your lease. Another rate to potentially look at is your bond buyer index, again, adjusted for your lease term and credit rating. Whatever you do, talk to your treasurer or chief financial officer to see if they know what would be your incremental borrowing rate for the time period of the lease. That time period is vital. After all, your treasurer may be used to issuing 20-year bonds, but if your lease is only for 5 years, 20 does not equal 5 the last time I checked. Whatever is chosen, document your policies and procedures. And as Lee mentioned, there isn't an alternative to impute or interpolate your interest rate. If you know the fair value of the leased asset and can estimate the fair value at the end of the lease, you can interpret or impute the interest rate. It doesn't always work. Imputation is almost the same as calculating the internal rate of return in Excel. And for those of us who have done it in Excel, it is not always a Swiss watch. So let's get back to our copiers. The government is a AAA rated government. The government drafted a policy saying that the bond buyer index for AAA governments at the point of the lease was used for lease term. Now, looking at the index, the date of the signing, that rate was 1.5%. However, this was a few years ago. However, the policy also says that 200 basis points are added to whatever index rate is chosen. 200 basis points is 2%. Therefore, the discount rate is 3.5%. So let's put this all together. And this is something we recommend you doing if you have, less than 100 leases, or you're keeping things in paper, put together a header sheet or something like that. Especially if you're going to use Excel or doing something by hand, is to put something like this sheet together. This might be a great way to document each lease. So we've leased our copiers from Canon. Delivery was December 29th, and it's a 60-month lease payable at the end of the month. And that's a very important distinction, beginning versus end. We're not purchasing the copiers because we normally don't do that. And the discount rate is 3.5%. So I mentioned some Excel, and if you're going to keep things in Excel, great. But realize there are internal controls issues if you have more than a handful of leases in Excel. Since we're using the effective interest method, just like a mortgage, we need principal, interest, and time. Remember, we are monthly, and our formula is at the bottom of the slide. And if you're looking at this on a cell phone, it's going to be pretty small, but the slides are going to be available to you, I believe, on our website and as a PDF. So bookmark or circle this one if you can. You know, you might have one of those right on screens with a little, you know, electronic thing. Bookmark it, because there's your formula right there to calculate this particular lease. And notice I've rounded things and so on. And obviously the numbers will change on your particular lease. And here are your first 6 payments. Now, I didn't include the other 54 rows as the print gets really tiny, but you can tell where this is headed, and it looks just like your mortgage amortization. That's there. So on what I did was I decided to collapse things into, you know, annual payments. Now notice the first year, the first year, it is only a partial year because we signed our lease on December 29th and we're a June 30 government. So we're going to have a partial period 1 and we're going to have a partial period 6. And you can tell it's a partial period because obviously the interest, annual interest expense goes up first and then down. And then look at the period 6, you only have $196 payable on this particular lease in the last period that's there. And that's obviously pretty small. Okay, for those of you who are looking at fund entries, and I know we got a question on funds, you know, on funds back a few minutes ago. So now we're going to record our leases. And notice a couple of minutes ago when I answered that question on funds, I only talked about ongoing leases. I didn't talk about conversion because I wanted to work through the conversion with you coming up on this slide. So here's our first entry. And let's say our government is using the general fund like somebody asked a few minutes ago. At the day of delivery of our copiers and we sign the papers and we take possession, we're going to record a capital outlay and a credit to lease proceeds, in this case of $177,000 and change, which is the present value of the liability. Now, if you receive some form of discount and so on, you know, some of those numbers may adjust. But let's just say at the day of signing, we're going to debit capital outlay, credit other financing sources, lease proceeds, and this is exactly like today, at least in terms of the fund entries. Now, you know, the interest factor that may change, and obviously the lease term may change, you know, in the conversion to GASB-87, but by and large, same as today. We then need to convert that information to the government-wide statements and then use the amortization schedule to determine the current and long-term portion. We also need to convert the capital outlay to an intangible asset. So on the screen there, that is your conversion entries. We're going to take care of the other financing sources by debiting them. And we're going to credit the current long-term portion of our lease liability. And then, oh yeah, we're going to record our intangible capital asset, which is going to say leased equipment. And we're going to credit our lease liability. Now, at the end of year 1, we need to do some reclassifications based on our amortization schedule a few slides back. And our government has decided to amortize the asset side of the lease at the same amount of the principal paid, which is acceptable, and in some cases preferable to straight line. So we're only debiting $2,983. Now, if you decided to go straight line, you would take that $177,278 divided by 60 months, but then multiply it by 6 months, or about $17,728. Either way is acceptable. You know, it's up to your policies and procedures and how your lease flow works. So Lee, how about some of the adjustments we may need to make?
All right. So, you know, there are other factors to be considering, including components incentives, modifications, and terminations. So components are common, especially for space leases. There's separate elements in each lease, including common area charges such as maintenance, utility, security. I've even seen landscaping. In any lease, we're going to need to separate those components and estimate their value. Now, many of these charges can be figured out by reviewing similar contracts that do not involve leases. So don't take this one lightly, because determining them out will of course affect your overall lease and the liability and the assets. Now, in many cases, there are multiple components involved in the lease. Think of the space you may be leasing. It may involve any one of these 5 elements, on the screen. And in addition to your principal and interest payments that you're going to be making. Now, to determine the components, you need to separate the principal and interest from the other components. Now, some components may have different terms. For example, let's say if you're leasing a truck and Ford covers the maintenance for a year, but the lease is for 7 years. You've got different interest rates will be needed, and of course, the amortizations are going to be different. So you're going to take a really close look at the lease agreement and the contract just to make sure that you have everything identified. Now, there are 4 steps to success in figuring out components that are on this slide. First is recognizing, identifying them. You may try using artificial intelligence to read the lease document, but that's not always effective. You will need the human factor to identify all of the components. Next, you're going to look for similar contracts if the contract is not identified in the lease. For example, of the one that we did of the 1-year maintenance contract on the truck is just that. However, if we didn't know how much the dealer charged for maintenance, or if it was completely variable, professional judgment is okay. If over or under, you're going to adjust. But if that is still not practical, then it's part of the lease. You can't really determine it from after all the work that you've done. Once the components are identified, separate payables for those charges need to be recorded unless it's not practical to do so. The goal will be to maximize the most observable information known. And again, the most common of these charges are common area charges, or also what we refer to as CAMs. Now, combinations are different. They can be our best friend. Instead of leasing 10 multi-function printers, copiers at the same time from Canon, it's only one lease. Document is needed as for the terms, conditions, and they are the same with the same counterparty. Now, combinations can also be found in laptops and so many other places. Encourage you to try to group these things as much as possible. It's going to make implementation far easier. Now, incentives are also common. You've seen these in car commercials. We'll make your first month's payment, or we'll pay your closing costs, or it's a 0% leases. Rent and holidays concessions are made by the lessor, which may be common for these days as well. And on behalf payments are all incentives. Incentives need to be known as they adjust the accounting for the asset and the liability. Now, accounting establishes the present value for the incentive, which is amortized based on timing or stream of incentives. And so in incentives areas can really become a complex area when trying to apply GASB 87. Now, modifications occur when an amendment occurs, adjusting all that important time factor, or in some cases, even the interest factor. Modifications can be terminations if the right to use of the asset decreases. If an assets are added, say new copiers, the lease may need to be recalculated. If a termination occurs, if early, it may result in a gain or a loss. Now, these need to be known as part of implementing the standard. Now, one of the most common questions we get in implementation is where governments want to establish a threshold for recognizing a liability. Can my government use the same amount as recognizing an asset? We have that threshold. We disclose it in the footnotes of what we're going to capitalize. Well, think about it. Let's say if your capitalization threshold for equipment is $5,000. Anything below $5,000 expense, anything above the $5,000 is capitalized and depreciated and tracked. Does your government do the same for liabilities? In other words, I mean, do you not record liabilities unless they're over $5,000? A little bit of a different of a threshold between the liability versus the asset. GAAP requires that liabilities that are significant, either individually or in the aggregate, need to be recognized. So how do you determine significance? There are GAAP provisions that would suggest the word significant means less than material. Well, what's material? Back to my bad joke of what is adjacent to, how far is adjacent to, but also remember the word materiality is mainly, an auditing term and not an accounting term. But as a preparer, what do you do? GASB, suggests considering the qualitative and the quantitative aspects of the lease. In other words, how would it be if not recording the lease shows up in your local newspaper tomorrow? Would it be a good story? Not such a good story. Those are the qualitative aspects. Bottom line is, when in doubt, record the information.
That's pretty much our first lease. Let's talk about a space lease. And no, we're not talking about 60 miles up in space. We're talking about office space. Here we have a government that is signing a space lease for 600 square feet. The lessor is unrelated to the government. Again, this is a real lease that I'm summarizing. I couldn't do a screenshot of this because there were just too much identifiable information in it. The lease was signed last July 22nd, and the government moved into the 15 feet by 40 feet square feet, 600 square foot space on August 1st. This one luckily has a parking space. The term ends after 60 months. And the payment is at the beginning of the month, beginning the first day. So whoever's moving into that office brought in, a computer, an office plant, maybe some coffee mugs and so on, and they had occupancy of that particular space. The first year's monthly rent is $2,935. Thinking about that, that's pretty expensive office space for only 600 square feet, but I'm not surprised. There is an additional $84 in common area maintenance charges, or CAMs, that Lee talked about. And this particular lease also has an escalation clause, like many, many space leases. So now at signing, the government also paid a security deposit for $2,935. Like most space leases, it's the first month's rent, which is returned at the end of the lease as long as whoever's occupying the space doesn't trash the office. All other charges attributable to that office are paid by the government, including utilities and insurance. So they are paid by the government, not by the lessor. Now, the lessor can terminate with 18 months notice, but in the past, the lessor has not done so in this particular office space that the government leases. So let's put this all together. Let's pull out our handy dandy worksheet, which we did a few minutes ago. We took occupancy on August 1st of 2020, and we are implementing GASB-87 next week. So this is really real. The non-cancelable term is 60 months, but those of us with 10 fingers and 10 toes, we're going to count, and we say, okay, August, September, October, November. Remember, we got to pay the first day of the month, so we got to count August. The non-cancelable lease is 60 months, but only 48 are left, as we're going to convert this lease to GASB-87 on July 1st of 21. And since the lease is paid at the beginning of the month, no payment is due for the July 1st payment, since we paid it. We're not going to split hairs here and say, gee, did you pay at 12 midnight and 1 second or 11:59 right before? Let's not split hairs. Let's just say we already made our July 1st payment. We're not going to purchase the property. And in this particular case, we're going to assume a 2.49% interest rate based on our policy. Here, this particular government used the same formula. We're going to look at the index, and at that particular time, it was 0.49%. We're going to add 2% to it, so it's 2.49%. The AAA index dropped from when the copiers were leased in the first lease that we worked on. Because as we all know, COVID happened, and so clearly numbers changed. So here are our numbers. Notice again that our liability is as of the day of implementing GASB 87, and notice that our final interest expense is very small as it is the final payment. I mean, this is serious. It is a real lease. Our final interest payment is $7 whole. Now, I know what you're going to say. You're going to say, how do you calculate a lease with escalation? Well, effectively, you're going to have to do, let's say this particular one is a 5-year lease or a 60-month lease. This particular one, you're going to probably have to do, if you're going to do it in Excel, you're going to have to do 5 separate spreadsheets and then add them all up to calculate your liability. That is a lot of manual work. And so even if you have only 2 or 3 of these, you start to realize that Excel may not be your best solution. A lot of the software packages that are out there do escalations, and they will work for you in that regard. But let's just say we're going to use Excel. So yeah, can you use 4 or 5 different spreadsheets and then add them all together? Sure. But you're going to need some additional work. The CAM charges are $84 a month, and they also escalate. So you're going to have a separate accounts payable. It is not part of the lease. We have additional payables for utilities and other office charges. The security deposit is receivable, or if it's netted off the final payment, it's a reduction of the lease payable amount of the $147,000 and change from a few slides ago. If it's reasonably certain, we're going to receive it without reduction. Now that would be unusual as we put up pictures or so and over the 5 years. And, you know, there may be some holes in the wall. I mean, think about it. For example, I have a leased car. And here in Washington, D.C., in the Washington, D.C. area, the parking garages, those curbs are really narrow. And my car is a big Toyota. And guess what? I've scuffed up my wheels a little bit already. And even though my car is, about 6 months old, and it's simply because the garages here are really narrow. Do I freak out about it? Yeah. Will it cost me some money at the end? Perhaps taking out of my deposit? Sure. But that's part of what we deal with in a security deposit. There's also a termination clause. Remember from earlier today, we need to determine whether or not that clause will be exercised. So there's all these other factors that we need to calculate as part of our lease equations. So Lee, why don't we talk a little bit more on the debit side of the equations?
All right. So, we've been calculating the liability. So what about the asset side? Our asset's going to be an intangible asset. It's the right to use the lease property, but it may not be the same value as the liability, even at the lease signing, as it discussed earlier. We need to adjust the liability for any prepayments and any lessor incentives to arrive at what that lease asset is going to be at on day one. As Eric introduced, the asset can then be amortized in any systemic or rational method over the shorter of the lease or the useful life of the underlying asset. The amortization expense is then going to be included in the government statement of activities at the entity-wide perspective if you're a governmental fund entity, or of course it'll be in with your enterprise funds. Now it is separate from your interest expense and separate from your depreciation. So let's go back to our leases that we've been discussing. Let's say instead of the effective interest method to amortize, we're going to use the straight line for both the copiers and the office space. The numbers are right here. Notice that our useful life policy is there, and we're doing a shorter of the useful life for the lease. But on the office space, we're converting to GASB 87, and we've taken care of the first month prior to July 1st of 2021. Therefore, there are only 48 payments left. So we, of course, we divide the 147,466 by the 48 payments that are left. Now, of course, since we're in the middle of a baseball season, I'm going to throw you a curveball. Let's say your government decides to buy the copiers for $1 in year 4 when the contract terminates in year 5, and the copiers are in great condition. GASB 87 requires amortization or over the shorter the useful life or the lease term. But when we decided to buy the copiers, 4 out of the 5 years of the contract are already gone, and the contract is now a purchase contract. Our policy, the policy you've set up, says the copier is, lasts for 7 years. That means we have 3 years left on the purchased equipment. Since the remaining asset value is, $35,000, $456 from our amortization schedule, then we'll just need to divide by the 3 remaining years, and that is the new annual depreciation of $11,000. Do you have to restate? No. It's a change in accounting estimate going forward. Now, lease assets are also subject to other capital asset provisions. Certainly, assets become lost, stolen, damaged, fire, flood. They can become technologically obsolete, all leading to some form of an impairment. Remember, there are other occurrences that may cause changes in your lease liability, and all those options, those are measured with the factor of reasonably certain at the time of the signing of the lease. But what if the circumstances change? Those changes may cause a change not only the liability, but also the lease asset, especially if you weren't going to extend, but you decided to extend. That would be a change in the accounting estimate as well. The asset is then re-amortized, and instead of amortizing the asset over 5 years, you now are going to have a 2-year extension, and then it's for a grand total of 7 years. But let's say if you have an early termination, the amortization then gets accelerated, and a gain or loss may also occur.
I'm going to take you through some policies and procedures, and thank you, Lee, for what you've done on this one. And disclosures, policies, procedures, implementation. Disclosures will need to be made about leasing activity just like today. Pretty much disclosure that you have in your annual financial report, it does not change all that much. Obviously, the numbers are going to change, but the text probably would not change all that much. The leased assets, yeah, you're probably going to want to disclose those lease assets different from your other capital asset disclosure. But most of us are, have a little subtable or subsection as it is. There's also note disclosure that is very similar to what we do today. The existence, terms, conditions, any form of guarantees, variable lease payments, those should be communicated along with any sort of impairment losses. For example, we got a question a couple of weeks back, gee, my server is permanently hacked. I'm leasing it from a particular company. I can't open it. What should we do? And I said, well, you can ask us to try to remediate that electronically. And they said, no, we're just going to junk it. And in that case, that would be an impairment loss that you'd probably want to disclose if it's material. Any form of commitments made for leases that you haven't begun, those would also be required to be disclosed. So again, let's go back to our space lease. And we're not going to occupy the space for a while, and it's going to straddle the fiscal year. We're not going to occupy it till after Labor Day, but we signed the lease today. That's going to need to be disclosed. So let's talk about the policies and procedures. And I really want to emphasize this. To some, some folks say, hey, just come on in and implement. And we said, no, you really got to look at your policies and procedures. Because your internal controls are vital in your success in implementing GASB 87. And so if your independent auditor, one of the first things they're going to say, be it Eide Bailey or somebody else, is let's take a look at your policies and procedures and internal controls over the entire lease life cycle. Why is this important? As you've learned today, there's no more operating leases unless you happen to have a lease that truly scouts honor, cross your heart, 12 months or less without any possibility renewal. Now, coming up in the next webinar in a couple of weeks after July 4th, we'll talk about the lessor side and we'll talk about tenant leases. And in that case, yeah, a little bit more prevalent. But for right now, if you happen to have any lease without the possibility of renewal that is truly Scouts honor less than 12 months, then those are just outflows. For some governments out there, operating leases were most of the dollars that were in the note disclosures. Now, much of those dollars may now be like what we used to call the capital leases. They are real liabilities. Since they are now real liabilities, it's a good time to take a look at your internal controls over the entire lease life cycle. And guess what? So far, the efficacy of the internal controls we've started to look at, they're okay. They're pretty good. There are some that are great and some that, they need some work. There's nobody that is, oh my God, where, everybody heads to the exits, because most of us had some internal controls, especially with regard to capital leases. We now just need to modernize them because, hey, some of those policies and procedures may date back to when we started working on capital leases back in the 1970s, as we talked about at the outset of this webinar. So we need to really go revisit those. A lot of governments are focused on fiscal funding clauses, but the GASB reminds us that fiscal funding clauses has mainly a budgetary impact and not an accounting and financial reporting impact unless it's reasonably certain that your government would exercise those clauses. But as we saw in the copier lease, if the government does not appropriate funds for the lease, then the contract would terminate, and there would be a very material gap impact that would result in a gain or a loss. Another aspect would be whether recording a lease triggers any other issue. Remember, leases are liabilities. In other words, they are debt. Does the recording of a debt trigger a violation of a debt limit, a law, a regulation, a bond covenant, a bond continuing disclosure? All of this and other compliance aspects are going to need to be considered. One of the most overlooked provisions is with leases funded by federal grants. The Uniform Guidance has a requirement that if you're seeking reimbursement from a federal award, most federal grants only reimburse the lower of lease expense or depreciation. The lease expense is also subject to a lease versus buy decision that is required to be documented. And so part of the implementation that we would work with you is to make sure there's some policy or procedure that documents that decision in implementing GASB 87. So this and the next slide are the bulk of a checklist for you on policies and procedures. Notice the first list here is the first word on the list. If you take a look, it says who, how, and where. These all need to be considered by any government that has more than one person doing everything. Consider why these are important. After all, if you don't know where all your records are and how they're maintained, how do you know you have a complete inventory? If anyone can execute, extend, modify, or terminate a lease, change interest rates, purchase, renew, cancel leases, as some say, the inmates are running the asylum, you will have chaos. So you need some entity in charge. That word who is vital in implementing GASB 87. And who is held responsible. And we know there are plenty of organizations out there that are decentralized organizations. As long as you have some policy or procedure to capture how these records are kept, and triggers a reporting of executing leases or extending leases or modification of leases or terminating, sure, that would work in a decentralized environment. But there's other stuff you do need to consider. It may be great to get a free month on a lease. The apartment buildings that are surrounding Amazon here in Pentagon City, Virginia, all of them are offering free months on leases because of the construction going on. And it's great to get a free month on a lease, but you may have a law that says that the value of that free month is a gift, that under an ethics law, you cannot accept it. And by you signing that lease, you trigger a problem with that law. Remember what Lee discussed on components and recognizing components. It's vital to have a consistent policy on recognizing these so you do not have material misstatements on assets and liabilities. Another policy and procedure to consider is running some form of internal check or reconciliation between what your accounting system says and what your lease documentation says. Those queries and surveys are vital to determine, again, do you have the inventory recognized and do you have the liabilities and assets valued properly? That reconciliation, I saw a demonstration of one at a client in the Northwest, and that is really slick. If you can do that automatically, it queried their accounting system and queried their lease software and try to do an internal match, and then it spit out a report of the stuff that didn't match. And if you can invent something like that, or you want Eide Bailey to help you with something like that with our advanced data analytics group, we would be honored to work with you with and do something like that. Finally, remember, GASB-87 is not a set it and forget it standard. Your government needs to constantly update and maintain this information. How you do that is another policy or procedure your government needs to consider. Okay, a lot of you have been asking, okay, how do you implement GASB-87? Do you have some form of cheat sheet or materials? Well, here you go, folks. You get what you ask for. Teamwork is vital in all but the smallest governments where you are the chief cook and bottle washer. And if you are that chief cook and bottle washer, you are that sole person doing all the accounting and financial reporting, we would love to hear from you and work with you because you're probably going to need some assistance. Think about what you've heard so far on GASB-87. And I hope you realize that you need the folks on the screen to be part of your team. GASB-87 goes beyond accounting. You need internal auditing or an external auditor to determine if you have the inventory, are the policies or procedures effective, are your internal controls operational. You need treasury and finance to set the discount rates. And they may already be part of a negotiating team for leases. So why not have treasury and finance part of your team? We're finding out that the break point or breaking point of whether you can use Excel or some other worksheet versus some other software, ballpark 25 leases. Anything above that are going to be pretty difficult to maintain. It's going to take you a bunch of hours at the close of each period. And someone with systems needs to be part of the team. Legal, purchasing, governance, that's pretty self-explanatory because they're the folks who may be held accountable for some of these decisions. You really need a team working on GASB-87. Here's why. The focus of the areas of the audit will likely be in these 5 items. We do not have a state and local audit guide as of this morning that I looked. It's not out as of yet, but we know that the focus area is going to be over and over again that top word, completeness. If you do have a right on screen, circle it. Completeness will be everything. Recognition and measurement will be second. The third will be presentation and disclosure, but presentation and disclosure does not change all that much. Compliance and related parties also need to be considered, and that's why a team is vital. So the time is now to implement. Do not wait until Eide Bailey shows up. Don't wait for your independent auditor if it's not Eide Bailey. The time to implement is now. You need time to do this and to get results that are fairly stated. Okay, how do you convert? Let's say we have a capital lease, and this one's been around for a while. The discount rate is 5%, and at day 0 on the capital lease, we had a $45,000 capital asset and liability. But we are pretty far down the road on that lease term, and when we implement GASB-87, our asset value next week will be $20,900, and our liability will be $21,500. And the reason why it's different is on our asset, we did straight line, and on our liability, we use the effective interest method. We're going to reassess the discount rate and lease term. And by the way, since we had to reassess the discount rate to GASB-87, we had to mark up the liability by $1,000. Based on our facts and circumstances at the beginning of the year, coming up next week, we need to do an adjustment for the liability of that $1,000. The offset would need to adjust the asset to net position. And so the debits and credits pretty much fall into place. The difference between that 22,500 and the 21,900 and the 21,500. So you're going to have a $600 beginning balance adjustment. Okay, so you record based on the facts and circumstances at the beginning of the year as of next week, and we'll need to do an adjustment for that $1,000, and the offset will need to adjust asset and net position. Now, if you have comparative financial statements, we got to go back to the beginning of 2020 if you're June 30. So there will be some adjustments that may need to be made and roll forwards. Okay, let's keep going on this one here. Come on, there we go. All right, to implement, one thing we recommend is to separate leases into 3 buckets. And we talked about one already. That's that operating lease that was in the polling question. But you're going to have capital leases in addition to the operating lease, and what I'll call special cases. And the special cases are the leases that are going to require special treatment. And these include things like sublets and sale leasebacks and lease leasebacks and related party leases. And once we have that population into those buckets, there's going to need to be some review of the terms and conditions and incentives, and then you run the calculations and prepare the disclosure. But it's the gathering of that population where the bulk of the work occurs and reading those leases. There's only so much of them that you can machine read. I mean, there was one client we implemented, they had some leases going back to the 1970s, and try reading a lease document that is prepared in the 1970s, and that print was hard to read. And so no artificial intelligence worked, and we really had to read it. And it's so gathering that population.